there. Welcome to my YouTube channel. So, in the last 2 days, I've spoken about risk in investment. With yesterday, I've spoken about the different kinds of risk or different types of risk that could be involved in investment. I spoke about 9 types of risk. So, the whole intention was to give you an academic view of investment so that all you investors are aware and you are careful before you invest in stock market or even in cryptos or any other kind of investment. Today I wanted to talk about the calculation of beta in calculating risk in investment. This is very crucial because it's kind of a systemic risk, and hence it is actually systemic risk. So it is very important that all you guys are aware of this particular beta, so that it helps you in your risk calculation before you actually put down your monies into any kind of investment. So let's talk about it. Before we do that, as usual, my request to you, please like my videos, please subscribe to my channel, please smash that notification bell so that you know every time I upload a new video. Please like my videos, please comment on my videos so that I know what exactly you're looking at, and that way I could craft out a video based on your requirement, and also share my videos with people who you think would benefit from my research, from my insights, and from my knowledge. So without further ado, let's dive in. So as you know, before I talk about anything on on any topic, I talk about my ebook. Now this ebook is on my journey as an entrepreneur. So it's titled A Six-Figure Corporate Job to Master Entrepreneur. It starts with a time back in 2010 when I quit my six-figure globetrotting corporate job. It talks about it talks about my preparation before I jumped into the entrepreneurial world. It talks about the challenges I faced on the way, and it also talks about how I overcame those challenges. And I'm sure many of you would be interested in becoming an entrepreneur at the very first opportune time. So I have put down 3 worksheets in this ebook for you to gauge where you stand in terms of becoming an entrepreneur. So essentially your preparedness. So you answer certain questions, get points, and based on that you will know where you stand. The cool thing is I've scored myself in those questions or the questionnaire that are there in the 3 worksheets, and you will know how much I scored, as well as you will know how I stand or where or how successful I am today as an entrepreneur with 2 companies, one in Singapore, the other one in India, and representations in the US market. Now, the greatest thing about this ebook is it's available to you for free of charge. It's available on my website. The URL is flashing on the screen. I'll put down the URL in the description box below. Click on it, go to the page, put down your name and email address, and the link to download the ebook will be emailed to your inbox. I hope you like the ebook. Do give me your honest feedback. Now let's talk about beta. So systematic risk. So what is it? That's what we're going to talk about first. So systematic risk is that part of the total risk that is caused by factors beyond the control of a specific company or individual. Systematic risk is caused by factors that are external to the organization. All investments or securities are subjected to systematic risk, and therefore it is non-diversifiable risk. Systematic risk cannot be diversified away by holding a large number of securities. So if you look at on the graph on the right hand side, the total risk is a sum of systematic and unsystematic risk. So if you see if the total portfolio, that's the graph. Systematic risk is something which is almost, as I said, is based on the factors which are not under your direct control. So hence it is the graph the curve starts from above the systematic risk. And beyond that is, of course, the unsystematic risk. Now, systematic risk could include market risk, interest rate risk, purchasing power risk, and exchange rate risk. Now, I've spoken about all of these risks in detail yesterday in the video. I would urge you to go and take a look at that particular video. Now, let's understand the calculation of systematic risk, that is beta. So systematic risk is that part of the total risk that is caused by factors beyond control of specific company, such as economic, political, and social factors. It can be captured by the sensitivity of a security's return with respect to overall market risk. This sensitivity can be calculated by beta coefficient. The beta coefficient is calculated by regressing a security's return on market risk. Now, that is very, very crucial. Now, the calculation is something like this. So, if the beta, so the total portfolio return would be alpha. So now alpha is the term which is, I'll explain more in detail, which is without any kind of risk at all. Now, when you add the market return and you add the coefficient on that, so the coefficient times the market return, and then you add the error, that's when the portfolio return it becomes more meaningful, because it is far more aligned to the risks that are associated with return. So it's not just so portfolio return is not just the alpha, it's also a summation of these three elements. So RS is the return on particular security, while RM is a market return. It can be observed that beta is the regression coefficient of RS on RM. The intercept term alpha shows a security's return independent of market return. So it's without any kind of market return or any elements in the market. So it's basically is more ideal case return. Now let's also try understand how do you arrive at the value of beta coefficient. The value of beta can be calculated using the following formula. The formula, there are two actually formulas. One is the correlation of RP over RM with a multiplier of a ratio of portfolio standard deviation and a market standard deviation. Now, why this deviation is important? Because there is always a fluctuation in the portfolio. There's also a fluctuation in the market. So if you put it within those standard deviation, that's where the delta P and delta N come in, and that's the ratio. So essentially, portfolio over market standard deviation is the calculation with respect to the correlation of RP, or the portfolio return, over market return. It's also calculated on a covariance, which is a covariance of portfolio return over market return with the variance of market return. Now, of course, there are these two ways to calculate. We typically go by the first calculation. They more or less come out to be very close to each other because there is a variation. There's a covariation, and hence it would be slightly different from the correlation, but it more or less gives you an indication as to where the market is moving, and hence before you invest, you take your chances or your decisions on these. Now, I'll try and explain this a little bit more in the next slide, where I would talk about the beta of the stock or portfolio measures the volatility of the instrument compared to the overall market volatility. It is used as a proxy for the systematic risk of the stock. and it can be used to measure how risky a stock is relative to the market risk. When used as a proxy to measure systematic risk, the beta value of a portfolio can have the following interpretations. So we'll try and understand the interpretations. First, if beta is 0, it suggests that the portfolio is uncorrelated with the market return. So if you go back onto that, if you go back here, if you go back into this formula, if beta becomes 0, so beta Rm becomes 0, right? And hence, if you ignore the error term, Rp is equal to alpha, which is the securities return independent of the market return, right? So obviously, if beta is 0, it is uncorrelated with the market return. Whereas if beta is less than 0, it's a negative. It suggests that a portfolio has an inverse correlation with the market return. So then obviously, if the market return goes down, then the beta, the stock will likely to go up. So that's the inverse. When beta is between 0 and 1, it suggests that the portfolio return is positively correlated with the market return, however, with smaller volatility. So it's in line with the market return, but very little, fluctuation. But if beta is equal to 1, it suggests the portfolio return has a perfect correlation with the market return, portfolio return. So that means it's not equal, but the correlation is the same. Whereas as beta is more than 1, it suggests that the portfolio has a positive correlation with the market. And of course the volatility is likely to be is more. So that's where that's what the interpretations are of beta. And to summarize, in this particular video, you've learned about the systematic risk, that is the coefficient of beta, or beta coefficient, and how it is calculated. And also, you've also learned how the different values of beta are interpreted when it comes to the correlation between stock return or portfolio return with the market return. So it's a very classic statistical analysis, and it's for any individual small-term investor. It's very easy to calculate. If you are a large, if you're an investor who's very active and has massive portfolios, then you might want to take help from somebody who is an expert in this. You could reach out to me on that as well, and therefore we will be able to give you the right direction in terms of your investment. Before I go, I would like to point you to the video I did yesterday on the 9 types of risks in investment. I think that'll be useful, and that should serve as a prelude to today's video. So that's why I'll put that in the video link in the card above. Go take a look at the video. I'm sure it'll be useful to you. So thank you very much. I hope this was useful for you. As you know, my name is Saurav Mukherjee. I'm a digital and technology marketing leader with over 20 years of global experience. You will find everything about me on my LinkedIn. I'll put the LinkedIn URL in the description box below. Go there, go to my profile page, take a look at it. If you like, go ahead and connect with me. I regularly work with clients where I try and solve their business, marketing, technological, and investment challenges. If you are looking to engage me as a consultant in your company, you could please drop me a line on LinkedIn, or you could write to me on the contact page of my website. I'll put on the link to the contact page of my website in the description box below. Then we can have a call and communicate on how we would work together, how I could help you in your company or in your business. So before I go, as usual, please like my videos, please subscribe to my channel, please smash that notification bell, please comment on my videos, and please share my videos. So until next time, you stay safe and stay healthy, and I shall see you soon. Bye-bye.